Hey everyone, welcome back to your weekly market outlook, where we break down everything you need to know for the week ahead. Last week we saw some major volatility with the Nasdaq dropping a staggering 5% intraday before clawing back later in the week. The Federal Reserve made headlines and we got some key economic data giving us insight into the state of the economy. Plus, we'll dive into the biggest takeaways from January's market performance, key economic events to watch this week, including the all-important jobs report, earnings season nearing its end, with big names like Google and Amazon reporting, and finally, a technical analysis of the indices to help you prepare for what's next. So, if you're an investor, trader, or just market curious, hit that like button, subscribe for weekly updates and more, and let's dive in. Alright, before we dive into the upcoming week, let's take a quick look back at January 2025, because wow, what a month it was. On January 20th, Donald Trump was inaugurated as the 47th President of the United States, marking his return to the White House for a historic second, non-consecutive term. Markets are a bit apprehensive about the potential for trade wars with trade partners stemming from promised tariffs. We'll be watching this and other potential policy changes going forward. The markets enjoyed a big move upward despite some wild swings. The Nasdaq was up 2.2%, the S&P 500 2.7%, Russell 2000 2.5%, and the Dow Jones was the leader up 4.7%, perhaps indicating an emerging rotation into more conservative companies from the Nasdaq high flyers. This past week in the markets, the Nasdaq plunged 5% intraday on Monday, its biggest one-day drop in months before bouncing back. This was reportedly triggered by reports of China's DeepSeek AI engine beating ChatGPT and built at a fraction of the cost. I covered this news in a market analysis this past week. This news weighed especially heavily on AI darling chipmakers, Nvidia and Broadcom, although they too recovered somewhat the rest of the week. The Federal Reserve kept interest rates unchanged, citing a strong labor market and steady economic growth. But Jerome Powell made it clear that they're taking a wait-and-see approach, which means rate cuts aren't guaranteed anytime soon. We also got a first look at Q4 2024 GDP, and it came in at 3% growth, slightly above expectations. That's a bullish sign that the economy is still expanding at a healthy pace despite fears of a slowdown. So, the bottom line was that January was a good month for investors, but if the past week is any indication, could be a bit of a roller coaster. Looking ahead to next week, we have a few economic reports due that could move markets. The January employment report is the big one, and that comes out Friday at 8:30. Markets will be watching this one closely to see if hiring remains strong. The expectation is around 170,000 new jobs, and an unemployment rate of 4.1%. A couple implications about these numbers. Good news could be bad news for some. A strong employment report could mean interest rate cuts get pushed out further. A weak number and the discussion will center around recession. If wages rise too much, inflation fears could spike again. So, a lot to consider on this one, although my thought is that this one report is unlikely to signal any major shifts in the economy or the Federal Reserve's position. Earnings season continues this week with a few notables coming. Google is set to announce on Tuesday after the bell. The company is expected to post a 29% earnings growth with revenue climbing 12% to $96.7 billion. Especially of interest is Google Cloud growth and AI competition from Microsoft. As I have mentioned previously, I am concerned that Google's core search business will be adversely affected as a result of AI engines. We'll see. On Thursday, Amazon will announce their earnings, and this giant is expected to see 49% earnings growth, with revenue up 10% year over year. The focus here will be on AWS growth and consumer spending trends. These two companies represent significant percentages of the Nasdaq and S&P 500, so major divergence from expectations could have material impact on the broader market. Alright, now let's zoom into the charts and talk about the technical setup for the major indices. After last week's volatility, where are we headed next? Let's break it down. In the short term, the price action last Friday was concerning. All of the major indices had major reversals. The S&P 500 was nearing all-time high levels before closing down 0.5% on the day. The Nasdaq was up over 1.6% intraday before also closing down slightly. From a technical perspective, I consider this a short-term bearish trend, which will likely mean lower prices early in the week. The MACD is still in positive territory but has been deteriorating and could be a signal of downside pressure to come. Starting with the SPY, the S&P 500 ETF, the overall trend remains bullish with a major channel still in place since November 2023. Given the multiple contacts near the all-time high of 610, we will watch this resistance level closely. Any breach and close above this level would likely indicate a breakout upwards. If the pattern deteriorates, we expect initial support at 595 with a major break at lower than 585. So a couple things to look for. As for the QQQ, the Nasdaq ETF, it has had a similar channel, although a bit messier. The difference is the consolidation that has been occurring since its all-time high in December at 540. With a few attempts to move higher repulsed of that past month and a half, it seems that we will need some more support before moving higher here. A bit of concern, aside from the near-term reversal of Friday, is the deterioration of the MACD, which could signal some selling pressure. Key levels to look for on QQQ: short-term support at 510 with long-term support at 500. A breach of the 500 level could signal a disruption of the long-term bullish trend. There was one major divergence I saw this week. On Monday, as the Nasdaq was down over 5% intraday, consumer staples rallied. In fact, XLP, the spider for consumer staples, was up 2.7%, an indication of a flight to safety and major rotation of investment. Definitely something to keep an eye on. Well, there it is. I hope you found this information helpful. Please like and subscribe and get notified of new videos. Thank you for watching. Until next time, good luck out there. As always, the information presented in this video is for educational purposes and should not be considered financial advice. Be sure to evaluate how these securities align with your financial needs and consult with a professional if needed.